rules. Money rules. Money. Welcome to the Money Rules podcast, where we tackle your personal financial matters with leading financial advisors. Your host, Boitumelo Ntsoko.
Retirement is often seen as a time to stop investing and start enjoying the fruits of one's labor. However, with life expectancy increasing, investors face a longer retirement period, which means their savings need to last longer too. This may require a change in retirees' mindset about investing after retirement. Joining us on this episode to discuss the benefits of post-retirement investing and why retirees should view themselves as long-term rather than short-term investors is Marius Fenwick, who is a certified financial planner at WealthUp. Before we start though, please don't forget to follow us on Spotify and Apple Podcasts, share this podcast with your friends, and download our episodes for easy listening on the go. Your support will help us grow. Marius, many retirees view themselves as short-term investors, primarily focusing on drawing from their savings to cover expenses. Why is it crucial for retirees to adopt a long-term investing mindset?
I think, when we plan, it's all the age-related things. So we try and plan up to the age of 100, unless we are told otherwise if there's some health issues, etc. So, if you retire at the age of 65, you still got a 35-year investment horizon. And if you're 80, you still have a 20-year investment horizon. So the problem with that is that your main objective of investment should be to beat inflation. And the only asset classes that give you the opportunity or a fair chance to beat inflation is that of growth assets and offshore. Cash can't do it. If you're any form of taxpayer, then, cash is going to fall short.
So when it comes to investment options, retirees may prefer fixed deposits or bonds, which are considered safer. Could you elaborate on why they should consider maintaining a portion of their portfolio in stocks?
Fixed deposits, it's the same as for cash. You battle to beat inflation if you take tax into consideration. So even as a low taxpayer like 20% takes away a big chunk of that return, which brings you very close to a inflation kind of return. And retirees generally have a higher inflation rate than normal individuals because of medical expenses and the cost of care. Bonds are safe as the bond issuer. But remember, bonds are very volatile maturity because interest rates and inflation have an impact on bonds. So if you intertrade your bond, you can actually have capital losses and severe capital losses if you're in an environment where interest rates go up or inflation spikes.
Inflation is a critical factor that retirees must contend with. How can they protect their purchasing power and hedge against inflation risk while maintaining a balanced portfolio?
So, I mentioned a bit earlier on the only real asset classes that can beat inflation are equities and property long term, or the property has been very volatile of late. So one's got to get that exposure to beat inflation. But there's a few things that one's got to consider. The one thing is if you look at what the purpose is of the funds that the retiree has, let's say it's not just retirement funding. So the two big crucial things there is what's the income they're drawing and do they have intention to transfer wealth? In other words, on their death, must capital be transferred? So that'll depend what the portfolio should look like. If they only drawing 2%, for instance, of their total wealth, then you can sit in cash, especially if cash is sitting at 8.5%, because you're reaching all your objectives. But as soon as you want to transfer to the next generation, your investment term actually extends, which means you've got to take exposure to growth assets to basically beat inflation.
Let's talk about asset allocation more. How should retirees adjust their investment mix as they transition into retirement?
I think the biggest challenge for retirees is that their inflation increases with age. As I mentioned earlier, your medical expenses do start spiking. Care costs are expensive. So inflation is the big enemy of retirees. So what we normally talk about, I always refer to these things as pots, is basically create three pots. The one where you've got your cash reserves, so you've got your emergency funds in this one little sector, so to call. Plus, you could put in income for a period of 3 years. So then for the next 3 years, that little investment that's set aside will pay your income. It's there for emergency reserves. Then the balance of that, split that about 50-50. So I would say about 25% of your total wealth. Stick that into something like a low equity fund or your stable fund kind of funds with some offshore exposure, and the balance into more of a medium and high equity portfolio. So you basically got three portfolios in one. It does make your portfolio a bit complicated, It looks like a lot of investments that you've got in one portfolio, but that does meet all the criteria that you're trying to match. It gives you your short term. It sorts out your short term cash requirements. It gives you that medium term up to the 5-year span that you need some decent growth. And then the other one in your higher equity kind of component, that's your 5-year plus kind of investments. So that seems to work fine. The one place that one just got to be very careful of is offshore exposure when you're retired and you're drawing income. Now, I'm very pro offshore. I love offshore. I think it's great. But as soon as you start drawing income against the portfolio, offshore work against you as far as volatility is concerned. And a bigger enemy than inflation for income is volatility. So if you've got rand fluctuations and the rand strengthens like we've seen now over the last couple of weeks again, that actually works very negative against the offshore portfolio. So one's just got to be mindful. The more you draw as a percentage against your investments, the lower your offshore exposure should be. If you're drawing 2.5%, 3%, I mean, you can have 60 or 80%, doesn't matter. But if you start drawing around about that 7.5% and 10% like some people do, you've got to be very careful. You've got to look at much, much lower offshore exposure in those circumstances.
So for those retirees who are desiring to have more offshore exposure in their investments, how do they go about this, given that some fund managers are limiting access to this as they reach their house limits? Is a discretionary investment separate from the post-retirement fund an option worth considering?
Most certainly. I think for more reasons than just the offshore side. I mean, if you've got discretionary funds, you've got much more flexibility in terms of creating income streams that are more tax efficient. Because remember, if you're drawing against voluntary investments, you pay capital gains tax. Whereas we're drawing against compulsory money, you're paying full on income tax. So it's not just about the offshore. I think it's important that one must try and have about a 50-50 split. But getting back to the offshore question, I mean, that's the one that you alluded to. As I mentioned earlier, the exposure to growth assets is important, and in those growth assets, you have the offshore side. I mentioned to you that volatility is your enemy when you're drawing income, and it's actually got an inverse effect on the sequence of returns. So when you actually working towards retirement and you're investing on a monthly basis, you actually want volatility. The more volatile the currency is, the better for you, because the weaker the rand gets, or the stronger the rand gets, the more units you buy. And in future, when the rand depreciates, it actually counts for you. It works absolutely the opposite with retirees. So if you invest when the rand is on a weak spot and it starts strengthening, that works absolutely against you. So the sequence of returns becomes very, very important. And although we against timing the market, the price of the currency at the time that you go into an offshore market when you're retiring and drawing income, I mean, that's very, very important, because the rand volatility just creates so much more volatility in a portfolio that you're drawing income from.
Marius, is there ever a scenario where retirees should cease investing in stocks entirely?
I think, as I mentioned earlier, it's all about, I think there's two scenarios. The one, what your income is, and if you're drawing and you can draw the equivalent of, let's say, 25% of what you're earning in interest, you can sit in cash. But if you are drawing and you are drawing more than 50% of the interest rate, so if the interest rate's at 8.5% and you're drawing 4.25% or more, the tax implications of that works against you, and not so much in the year that you're drawing that income, but the following years that your income's got to go up and keep track with inflation. So you've got to earn inside living annuities. It doesn't matter because they're not taxed. But if it's voluntary funds and so on, one can sit in cash. But once again, if you want to let your assets transfer to beneficiaries, it's important to have that exposure to growth assets, because that's the time that that's the only way you can basically beat inflation and make sure that they have a decent inheritance.
Before we wrap up, do you have any final thoughts for our listeners?
I think at the moment there's quite a few things that are topical. I think be very careful at the moment for phishing scams going on. We see some of the big administrators like Alan Gray put out a warning. We know that some of the banks have been targeted and clients have had money pulled out. But I think once you've retired, you should have gone through your speculation phase. You shouldn't speculate. You should invest. Don't look at something that sounds too good. Don't speculate. Invest. Just be careful what you do. It's always the retirees that end up in a lot of scams and lose the most money. I think that's about it. I don't think there's anything anything more I can think of on the top of my head. Just the one thing, I think, if I can maybe just remember, the rand, it's not just a South African thing. People tend to get very pessimistic and negative with things start going in the country. It's an emerging markets, and we follow the trend of emerging markets. So it's not just a South African story. And if we go look back in history and see when the rand is blown out like it did about a year ago or so, it always recovers and recovers strongly. And normally what goes with that is a market that recovers as well. Like we've seen over the last month. Over the last month, we've turned the rand's turned about 8%, and the market is up better than the overseas market. So be very careful that you don't get caught on the wrong side of it. There's a lot of hype at the moment about taking offshore exposure in living annuities. Be very careful on the amount that you draw in income. That can turn around and burn you.
All right. Thank you so much for joining us on this episode, Marius.
Thank you.
That was Marius Fenwick, who is a certified financial planner at WealthUp. If you enjoyed the show, please make sure to follow us for the latest episodes, share the podcast with your friends, and download our episodes.
Thanks for listening to this episode of the Money Rules Podcast. To listen to more, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates. Moneyweb, your trusted source for business and investment insights.